Right, good afternoon, everybody. Thank you so much for joining our session, Safeguarding Credit Quality and Asset Value. I am absolutely delighted to introduce Apostolos Gkoutzinis, a partner here at Milbank in London. Apostolos is an international corporate finance lawyer who runs the firm's corporate finance and capital markets group in Europe. He has advised on some of the largest leveraged finance and high-yield transactions in Europe, and we're delighted to have him present today. Today's session is scheduled for 45 minutes, and I can assure you that there is plenty of content to cover in that time. So we are likely to take the full 45 minutes. Apostolos has kindly agreed to stay on for as long as he can. He does have a hard stop for 4 o'clock to answer as many questions as he can at the end of the session, so from 3:45 till 4. So if you would like to submit questions, please do so using the Q&A function at the bottom of your screen at any point during the presentation. And I can assure everybody that the recording and full deck will be available after today's session. And without further ado, I will hand over to Apostolos. Thank you very much.
Thank you. Thank you very much indeed. And thank you for Termgrid for the opportunity to present this webinar. Right. Covenants in corporate finance documents, term loans, syndicated term loans, direct lending transactions, high yield bonds, governed either by English law or New York law. Covenants are probably one of the most important aspects of a financing negotiation for a new transaction. I think the purpose or a potential restructuring, if things go wrong, covenants define what a company can and cannot do. And covenants are all about discipline and control. As you guys all know, companies typically in the leveraged finance market get into trouble primarily because of liquidity issues. And there is nothing that covenants can do when the problems have actually arisen on that front for genuine business purposes. But the covenants have a very significant role to play in creating the original parameters, the discipline, if you like, within which shareholders and management are allowed to manage the business, to either protect the asset of the enterprise, the assets of the enterprise from dilution, or avoid excessive leverage, or a combination, or prevent transactions that effectively dilute asset value or the ability of the company to generate cash in a way that either reduces the recoverability of the enterprise for creditors and or create liquidity issues or makes it impossible to refinance when the time comes. The key aspect of the covenant protection is obviously the fundamental part that fixed income investors, being loan investors or high yield bond investors, the best ever position for them is to get their money back, so that they are usually very reluctant to allow unlimited flexibility without the necessary protections for shareholders and managers to enhance shareholder value in a way that is potentially detrimental for creditors. So covenants play all of these roles in a financing structure. And today we're going to spend a bit of time going through the fundamentals and how all of you, as you are structuring deals or investing money, should be thinking about them. The main covenants that we see fall into one of a number of categories. So we have financial or maintain financial covenants that create financial ratios, either the ratio of the ability of the company to generate cash to service interest expense, known as FCCR, fixed charge cover ratio, or similar metrics, fundamentally how many times the company's annual cash generation can cover the financing cost, the interest cost, and obviously the leverage ratio, meaning the total amount of indebtedness over the company's last 12 months EBITDA, which is sort of the more frequent measure. Obviously, depending on the industry, you can have various formulations of those covenants. Maintenance covenants are require regular testing, and they lead to an event of default if the covenant isn't met. Fundamentally creates an early warning system for an early warning system if things deteriorate. The idea of a maintenance covenant is that if the financial metrics of the company deteriorate, the company may not necessarily engage in any value destructive transaction or credit destructive transaction. The company may simply go on about its business and still find itself in a risk of default simply because the headroom in the covenant has deteriorated. Incurrence covenants, on the other hand, which is the market standard in the leveraged finance markets, or the syndicated term loan B market, as well as the high yield bond market, incurrence covenants are tested when a specific transaction that is regulated by the covenant is entered into. So it will be tested if there is an incurrence of indebtedness, the raising of debt, or the payment of a dividend, or the repayment of a junior debt instrument, or the making of an affiliated transaction, the making of an investment, the merger of two different companies. Like any type of strategic transaction outside the ordinary course of business, effectively, is going to be covered by one or more covenants, and we're going to spend some time into the details of that. Covenants limit discretion. If you want to think about sort of the genesis of these covenants protections in the financial markets and their rooting of these covenants in the law, you should think about the board of directors of a company whose sole duty is to effectively enhance the value of the company for the benefit of shareholders. So absent an insolvency or the risk of insolvency, in every commercial system in the world, the board and the directors, and then obviously through deferred authority, the senior management of the company, the sole purpose of their day-to-day activities are to enhance shareholder value. So the company is not really run for the benefit of the creditors. And as a result, given absent the insolvency or the risk of insolvency, the creditors only have the four corners of the financing document and the four corners of the covenant protection to say to management, shareholders, and the board, we're fine for you to enhance shareholder value, but given that occasionally the interests of shareholders may conflict with the interest of creditors. For example, it may be a fantastic idea for the board to authorize a major new investment in a particular industry and borrow money to effectuate that investment because they feel that it's the right thing to do to enhance value. On the other hand, all of this enhanced value is going to be for the benefit of the equity holders. The debt holders in any structure will only get up to the amount of money that they originally invested. They only get their money back. So an investment which is financed exclusively through the raising of debt in a way that is perhaps unsafe for creditors may create value for shareholders, but may reduce the value of the credit. So for that reason, because even though the theory is that in the ordinary course of the operation of a business, the interests of all stakeholders ought to be aligned, and that is sort of usually the mantra that everybody is sort of kind of using, that a business is run for the benefit of everybody. Legally speaking, the reality is that there are lots of circumstances where a particular transaction may be quite value accretive for junior creditors or shareholders, and not value accretive for fixed income investors that have a senior secured claim who want things to be normal, as ordinary as possible, so that they can get their money back, and no particular risky transaction. For that reason, the fixed income markets insist on having sort of the covenant protections that we're going to discuss. Some thoughts on overall market dynamics. This is just my personal views on what's going on out there. I think when looking at covenants, I would say the syndicated loan market covenants typically tend to follow market-driven evolution. So long as there is plenty of demand for deals and good credits go to the market, covenants get loosened up because of competitive dynamic, and in the syndicated loan market, covenants tend to follow a market pattern. I think the high yield bond market more or less is the same, mostly market driven, and whether the covenants are loose or tighter. But perhaps in my experience in the high yield bond market, there is a bit more focus on the specific needs of the particular company or the industry, the structure. Maybe there is a little bit of a different flavor in how covenants are negotiating. I think if you move beyond the syndicated markets, high yield or loans, into the direct lending space, anywhere from the mid market to a large cap direct lending transactions, perhaps we see more bespoke and tailored covenant packages. What I would say as someone who's negotiated literally hundreds of these agreements, but more importantly, someone who's advised a lot of companies in the management of those covenants, particular transactions. Is this permitted? Is this not permitted? How does it work in practice? And even more so, having done a lot of restructurings and/or covenant litigation in the English courts and New York courts and elsewhere, when we actually see how these covenants work in practice, what I would like to say, I think, hand on heart, is often, and this is in my mind an interesting observation, there is quite a bit of divergence between what the market believes that the words that we're using mean when these deals are put together, and actually what the law as reflected in court judgments and jurisprudence actually says that the relevant clause means. I think in a lot of situations, people perhaps naively think that because a particular fact pattern was intended when the relevant clause was put into the document, that intention continues to acquire a life of its own into the future, and that it's unthinkable that situations that were never really contemplated, had never been contemplated at the time of signing the relevant contract, would actually come and use the relevant provision of flexibility or basket. I want to assure all of you that English law and New York law does not work like that. What the parties intended is almost, there are some exceptions, but it's almost never a point in question. I think judges in New York and London will always take a reasonably literal interpretation of what the words mean, irrespective of what people thought as the causal root of the relevant clause, what people may have intended or what people may have tried to solve. They will look into what the words actually mean on a reasonable literal interpretation. Like people would just get a dictionary and say, okay, here it says that so long as this particular transaction is in the ordinary course of business, it should be allowed. And the people who literally open a dictionary and say, what is ordinary course of business? And you may think that because it's an airline, this can only work in the context of owning and operating an airline. But if the particular airline has had a number of ancillary businesses in the past, they are using a particular a particular financing structure as a matter of course, etc. Actually, ordinary course may mean a lot more things than perhaps what was originally intended. So keep that in mind as you're going through in whatever capacity you are reviewing these documents and approving particular positions. Here, I have made an effort to separate investment grade from high yield and TLB covenant packages, you can see for obvious reasons, there is a lot less attention covenant protections in investment grade compared to the leveraged market. So if you go down this list, you see the strategic transactions that out of the ordinary types of transactions that the covenants are supposed to regulate. Raising financing, which is in terms of debt, limitation on liens. So first flag here for those who are perhaps less experienced in how this document works legally. In terms of debt, regulates literally the raising of money borrowed, plus a few other things that are tantamount economically to the borrowing of money. For example, certain contingent liabilities like letters of credit, letters of guarantee, a performance obligation, having, drawing on a current account, all of that is tantamount to borrowing money from another person. And the actual act of borrowing money is covered by the debt covenant. Limitation on liens is a separate covenant and deals with the separate but related matter as to whether the money borrowed is secured over assets. So in other words, the combination of the two covenants will always tell you whether secured debt is okay. If no collateral is being contemplated, in terms of the debtor's covenant will tell you whether you can incur the debt, so long as it's unsecured. If the debt is secured over any type of asset, then you're going to have to think about limitation of liens, which covers the collateral. Limitation on restricted payments, investments, payments of junior debt. This is all about effectively, think about it, again, depending on what type of loan deal or loan financing you do, we want to use the strong one here is a senior secured bond or a senior secured term loan B. So you are the first ranking, if you like. We're talking about the first ranking financing in the capital structure. And if you are the first ranking, you get an interest in limiting any value going into creditors or other stakeholders that have an inferior claim, meaning if you're first ranking, second ranking, or debt creditors, subordinated debt creditors, shareholders, etc. So the RP covenant is going to cover things like the payment of dividends, the making of distributions, share buyback program, repaying the principal amount on junior debt, and the making of investments, so long as the investment is not a controlling investment, it is a minority equity position in another enterprise. All of these things are covered by sort of what we broadly call the RP protection. Limitation of transactions with affiliates, it has a similar purpose. If you think about how value generated from an enterprise can actually go into the wrong hands. If you are a fixed income investor, it could be, for example, through a payment of an enormous bonus to someone affiliated with the shareholders, for example, which is not on an arm's length basis, or consulting contracts or other types of contractual arrangements that effectively pay somebody else who is affiliated with the controlling people in a way that is not on an arm's length basis, and it doesn't offer fair value for the credit. So in my mind, when I train my junior lawyers, the affiliate transactions problem always comes hand in hand with ERP protection. Limitation on dividend and other payment restrictions. I think it's probably this covenant, although it has some historical importance, we see it less and less these days. This makes sure that within the complex corporate group, money can flow freely from subsidiaries up to the parent level, and there aren't internal blocks into the structural or prohibitions of moving cash within a particular group of companies that obviously create issues for creditors if the creditors are getting claims at the top company level. Change of control protection, very important. I think fixed income investors are investing not only in the pool of assets, which is the enterprise, but also they are investing into a strategy, into a senior management team, and all of that are, I suppose, are concentrated on the controlling shareholder. So if the controlling shareholder changes, the idea is that investors should get the right to reassess and reaffirm their investment. Asset sales covenant does not prohibit asset sales. It regulates the fairness of these transactions and what the company will get in return for disposing of its assets. We are going to now see all of that a bit more systematically in the next 25 minutes, starting from the fundamental chart that you see here, that hopefully will be familiar to most of you, and it should allow you to take a conceptual view of the covenant perimeter.
Apostolos, could I just ask you to move a little bit closer to the microphone? That's all. I think the sound may not be. That's brilliant. Thank you. Apologies for interrupting.
Is this now better? Is this better?
Thank you. That's great. Thank you.
So the first question when it comes to a sensible drafting and an efficient drafting of the covenant package is what entities within the enterprise are subject to the covenants. And the main distinction is between the restricted group and the unrestricted group. The restricted group are the subsidiaries, legal persons within that are owned and or controlled by the issuer of the debt claim, in a way that the issuer of the debt claim can control the financial policy or management or operations of that entity. That usually comes with a 51% in most legal systems. A subsidiary is a restricted subsidiary if the issuer owns and or controls more than 50% of the voting stock, because that's how they control the policies and actions of the relevant company. It could be a 50-50 joint venture, but through a shareholders agreement or some other arrangement, the relevant subsidiary is actually de facto or contractually controlled by the issuer. So any entity that is controlled and can be influenced by the issuer is a subsidiary and is automatically a restricted subsidiary subject to the covenants, unless it has been designated as unrestricted subsidiary, meaning for either at the beginning of the deal, before the financing is put in place, or during the life of the financing, the relevant entity has been moved conceptually outside the legal restriction. So you can see here on the chart, for example, the US is the unrestricted subsidiary. So this is a controlled entity, but the management team has decided that they don't want that to be part of the covenants. You may say, well, that sounds great. Why isn't every company taken out of the control of the covenants? But obviously, there are consequences that flowing from the designation of a company as unrestricted. Yes, if it's an unrestricted subsidiary, it's not subject to the covenant. So the group, so to speak, can handle transactions at that level without being restricted by the covenant. So, for example, this US here can incur unlimited debt, so long as they can find somebody to lend to it, unlimited debt to do some sort of project financing or some major CapEx program. But obviously, if it's outside the restricted group, the ability of the restricted group to support it by way of additional cash endowment, additional investment, guarantees, or other credit support is limited, because any type of value that leaves a restricted group to go to the unrestricted subsidiaries for the creditors of the restricted group is lost. So there are always pros and cons, but I mean, what usually tends to happen is entities are almost are part of the restricted group when they follow the general financing policy and covenant restrictions. And then the management team has always the flexibility to designate a company into an unrestricted subsidiary if they have some special plans, if they want to over leverage or do some other strategic transaction that perhaps is not is in the interest of the shareholders, but cannot really fit within the corners of the relevant indenture or credit agreement. The entity to the right, EI, an equity investee, this is neither a restricted subsidiary nor an unrestricted subsidiary. It's outside the restricted group simply because the issuer directly and indirectly does not control an equity investee. This is probably a 20, 25, 30% minority interest without control rights. And given that the issuer does not control EI, the issuer does not want EI to be subject to covenants and then be restricted, because if you don't control an entity and that entity goes on and carries out its own independent financing policy, then obviously the issuer is going to find itself violating covenants with the actions of another party that they don't control. So EI's equity investees and unrestricted subsidiaries outside the covenant group, restricted subsidiaries, the issuer inside the covenant group. Guarantors are always restricted subsidiaries. So the giving of a guarantee will always be by restricted subsidiaries within the restricted group. In terms of financial ratios and reporting, I suppose two things to be said. The reporting, in theory, I mean, there are exceptions, but most of the market, I think, follows through faithfully the distinction between always reporting all the ratios as they apply to restricted subsidiaries and the issuer, and then if the reported financial statements obviously cover the entire group, but the group includes unrestricted subsidiaries, I think creditors usually want to know what is the individual performance of the unrestricted subsidiary or the financial performance of the unrestricted subsidiary group as part of the structure. Certainly in the bond market, footnote disclosure tends to be provided for any transactions at the unrestricted subsidiary level, so that the market can follow through the evolution of the unrestricted subsidiary cash flows, liquidity, and financial position. The point about the guarantors, the concept of a restricted subsidiary and the concept of a guarantor legally are two distinct entities. A subsidiary can be a restricted subsidiary without being a guarantor. A guarantor will always be a restricted subsidiary. The concept of a guarantee is a very important concept. It offers a direct claim for the benefit of the creditors against the legal entity, and the legal entity is also subject to the covenant. So it's both a restricted subsidiary and a guarantor. Other restricted subsidiaries that do not have a guarantee will be subject to the covenants, but in the event of an insolvency, will not really be capable of being sued for payment by creditors. Now, I think we will spend a bit of time on the limitation on indebtedness covenant, which is probably certainly one of the most important protections for creditors. The limitation on indebtedness covenant limits the incurrence of additional debt based on the ability of the company to service its overall debt. So what usually tends to happen in credit agreements and bond indentures, there will be a very wide and all-encompassing prohibition against the incurrence of any debt, unless the incurrence of that debt, after giving effect to the proceeds and the use of proceeds, so for example, refinancing or other use of proceeds, ensures that certain ratios that are specifically negotiated are met. So and then that's the first major limitation. No additional debt is allowed, very all-encompassing restriction, to be incurred by the issuer of any restricted subsidiary unless following the incurrence of that debt based on the last 12-month financial performance of the company, calculated on a pro forma basis. That also has real meaning. The ratio of fixed charges to adjusted EBITDA, which is the main sort of FCCR ratio, is met at the 2:1 level, or the debt to adjusted EBITDA ratio is satisfied. So either a leverage ratio is met, or a fixed charge cover ratio is met. Then there's no additional debt capacity. So unless these ratios are met. These calculations are always occurring pro forma for the transactions that are happening simultaneously. So if the new debt is raised to repay all debt, and then obviously we calculate the last 12-month fixed charge cover ratio as if the old debt had been repaid and the new debt had been incurred at the beginning of the 12-month period. So all calculations are giving real effect to all the transactions that are factually linked to the transaction that we're testing, and also by giving effect to acquisitions and or disposals of assets or other strategic transactions, depending on the deal. Obviously, the drafting can be quite elaborate, but the idea is that all strategic transactions that have happened in the last 12 months, which is sort of the common measurement period, and any other transactions that are factually concurrently happening at the time of the incurrence of the debt, for example, a new acquisition or a new disposal, all of these things will go into the numerator and the denominator of the ratio, so that the measurement of the ratio is as close to the reality of the situation as possible. So I'll give you a couple of examples. Debt is raised to acquire a new business. And this acquisition follows a disposal of a major business division 3 months ago. So let's say at the end of June, debt is raised to acquire a new major business. And this acquisition follows the disposal back in March of another significant business line. So we start with the last 12 months of reported EBITDA, but we have to subtract all other things being equal. We have to subtract the EBITDA attributable to the business that was sold. Otherwise, we are measuring cash flows that's just not there. But then we have to add in the calculation the new EBITDA that has been acquired by the group in connection with the new acquisition. If there are any other transactions that are factually supportable and they're covered by the wording of the measurement of the ratio, and there's usually a very, very long list of additional adjustments. Could be synergies, could be the cost effect of certain initiatives in connection with the new acquisition, certain initiatives in connection with the old disposal. Usually, all of these adjustments tend to increase the cash flows that are going into the ratio. But the idea is that you get as close as possible to an illustrative ratio of the recurring financial performance of the business, assuming all the strategic transactions that have happened in the last 12 months or are happening in connection with the financing that is being tested have occurred. So it's a far from a simple calculation, but it follows the logic of first let's normalize cash flows, let's exclude one-off items, let's take the benefit and or let's lose the benefit of items that are not going to be there. They are one-off exclusions. Let's include EBITDA that is being added. Let's exclude EBITDA that is being disposed of, and then you come into the ratio calculation, and it's a pass or fail test. There is no prize for nearly missing the ratio. If the ratio is missed, then you fall back on the typical formulation, which is all the additional baskets. We're going to go through some of them very quickly in the next few minutes. But the idea is there are the fundamental ratios. If the ratios are met, the transaction can go ahead. If the ratios are not met, the transactions can only happen if they are being met. They satisfy one of the relevant baskets. So that is sort of the usual, the standardized approach. There is a big initial enabling provision under the ratios, and then you have all the other baskets like the credit facility basket, purchase money or capital lease baskets, contribution debt basket, a general basket for all sorts of purposes. The idea is, if you want to take a deep breath, the idea is that a company needs to get the flexibility to carry out some of these transactions irrespective of the evolution of the financial metrics, simply because the EBITDA of the company has suffered temporarily and the incurrence of new debt cannot occur under the ratios. Doesn't mean that, for example, the company is not going to get a refinancing basket, because all finances are coming due, and the company, to the extent they can borrow, they should be able to refinance existing debt or have some general debt basket for general purposes. So there is a long list of exceptions to the ratio rule, which are either based on the use of proceeds of those exceptions, or like the general debt basket is for any purpose, for a rainy day, if you like. And then some of the other baskets, they kind of follow a particular logic. For example, the idea is that existing debt should always be refinanceable under the baskets. To the extent there's a willing lender to refinance existing debt, the company should never be in a position that they don't have ability to refinance. Otherwise, the covenants effectively become maintenance covenants. So, and the logic in the syndicated market is that the covenants should be tested on an incurrence basis. The liens covenant is, as I said, is always coming on top of the debt covenant. If you want to incur secured debt, the idea that you don't only test the incurrence of indebtedness covenant, you have to find capacity to incur the lien. Typically, the covenants, obviously, in a well-drafted indenture or financing or credit agreement, the two covenants are synchronized, and there's a logic that follows through these covenants. The idea is that there is usually an overall limit of secured debt that the company should be able to incur, pro forma for new acquisitions, pro forma for disposals, like the discussion we had 5 minutes ago. Any and all secured debt within that overall senior secured leverage ratio should be allowed. If that senior secured leverage ratio has been maxed out because all the relevant debt has been incurred, then again, we go into the same logic as we go through the indenture of finding specific baskets, specific basket for specific purposes. If the debt that we're refinancing was secured, we should be able to get collateral for the refinancing debt. We should be able to get, if the company gets a basket to incur debt to acquire, let's say, plant and equipment up to a certain threshold, they should be able to offer collateral over the machinery or the inventory or the plant or the equipment, which is purchased with the new debt. So that's the cap lease, lien basket, and so forth. Limitations on maybe this is probably 3 more minutes on the restricted payment covenant, and then we'll probably have to stop the my presentation to take some questions. Restricted payment covenant is really not one covenant, but it's several covenants combined in one. First, it's a limitation on paying dividends or transactions that have the equivalent effect of dividends, like share buybacks, other distributions to shareholders in their capacity as shareholders. The idea here is that there's usually in the high yield market, there is usually like a fundamental handshake between shareholders and debt holders when it comes to dividends. At 50% of the net profit accrued can go up to dividend payments, and then 50% stays in the business. Plus, in addition to the 50%, which we call the build-up basket, there are sort of more technical baskets that allow certain dividends to be made, depending on whether the company is a listed company or whether the company has issued other types of equity-linked instruments. For example, a convertible bond that's converted into equity builds the dividend basket. So the idea is that so long as equity value is created, an equivalent amount or an equal amount of equity value can go up to the shareholder. So in the term loan B market, the build-up basket is usually complemented by sort of available amounts for distributions, which the available amounts aren't really tied to the generation of accounting net income, which is a more of a high yield bond concept. The available amount is mostly tied to cash availability, like free cash flow that is available, for after servicing of debt and other operational expenditures. The idea is available amounts can be used for distribution. So a little bit of a different logic there between the bond market and the term loan B market, albeit, as I mentioned at the beginning, in all of these markets, especially for the top tier sponsor deals in the European space, have begun to converge, and we are definitely seeing a lot of the TLB concepts, going into the high yield bond documentation, and a lot of the high yield concepts going back into the credit agreements for TLBs. Certainly, I don't think it's tenable anymore to think in terms of credit agreement versus high yield bonds. There is a wholesale convergence of all of these terms. And I think Sophie will probably leave it at that. I think that we are hitting sort of the 45 minutes.
Thank you very much. Yes,
lots to cover, but hopefully, some additional good points can be covered through the Q&A.
Yes, thank you, Apostolos. And I encourage anybody who wants to put a question in to do so on the Q&A section. We do have a couple to get started with. You talked a little bit about the differences between the high yield bond and the TLB market. Can you expand on any more of those differences?
Can you hear me?
Yes, I can hear you. Thank you.
Sorry. Is there any way you can ask the questions? Because for some reason, technical reason, I can't see the questions. Is there any way you can?
No, so I will ask the questions. So yes, if it's just basically the main differences between the high yield bond and the TLB covenants.
So, it's an interesting question. The high yield bond market was developed primarily in the US, governed by New York law, and sort of following the American approach. The European term loan B market has borrowed a lot of the concepts from the high yield bond market, but has also incorporated quite a lot of the like LMA standard documentation from the syndicated loan market, which was originally, as you may know, an investment grade market for high quality loan paper. So where the leverage market has come to is in the TLB, a lot of influence from the LMA standard of the syndicated credit market, with a lot of influence from high yield, such that I think right now I think the position is, I would say, in most transactions, there is a great deal of convergence. I think there are some additional restrictions in relation to, let's say, permitted acquisitions or permitted investments in credit agreements that are not exactly matched in the high yield space. Certain prohibitions of sort of loan purchases, which are sort of unique to the syndicated loan market compared to high yield. I think we mentioned one in relation to restricted payments, where I think the idea of available amount for distribution is mostly based on cash available versus net profit generated, which is sort of the 50% build a basket for high yield. I think guarantors and guarantor coverage, obviously quite a big difference. I think it seems to me that there's always a bit more focus in the TLB market for a guarantor coverage that is, if you like, a maintenance test that has to be met. High yield is more of a day one guarantor coverage market, but obviously indirectly through the guarantor covenants in high yield, if there is a TLB in the structure, the TLB is getting certain guarantor protection, the high yield will always get it. So I think there are technical differences in deals where there is a high yield bond and a credit agreement side by side. In some of the top tier sponsor deals, I think the convergence is even more pertinent, and there where you see a covenant packages that are completely harmonious across the two, because from the perspective of the sponsor, and that's reasonable if there is a bond and a TLB side by side. Obviously, it makes sense for the flexibilities there and the covenant packages to be harmoniously coexisting, so that what is allowed under one is not prohibited under the other. So that's where we get most of the convergence.
Thank you.
Fundamentally, the ideas are similar. The differences are in the detail.
Thank you, Apostolos. I have had a question in, and I think you alluded to the fact that the high yield and the TLB market came from slightly different jurisdictions. So they're actually asking about whether the interpretation of judges according to UK or US law is more borrower or lender friendly.
It's a great question. I don't. I can say with a lot of confidence that American judges and English judges, they don't take sides in the debate for borrower or pro creditor. Generally speaking, both Anglo-American legal systems are pro creditor in the sense that in insolvency procedures and distressed restructurings, the two systems encourage rehabilitation by creditors, out of court settlements, support of creditors. The idea is that the two legal systems will allow all sorts of tactics and machinations in a positive way, so that the enterprise survives. Both legal systems, generally speaking, have an aversion to liquidation in insolvency, and they want to give as much power as possible for a solvent solution to be found. That's a more general comment about the attitude and the philosophy of the restructuring/insolvency legal regimes. When it comes to interpretation of covenants of solvent businesses, I think I can say with confidence that both the US and English jurisprudence look at covenants strictly. They look at what they say, and they give the ordinary meaning to the words. They're not looking for philosophical concepts behind the words. They're not looking into the intention of the parties behind the words. If the document says that a particular course of action is allowed, even if the outcome of that allowance may be commercially absurd, if the words are clear and the words are not contradicted by other words in the same agreement, the fact that perhaps it leads to unintended consequences is not going to be a consideration for English or New York law judges, with a couple of variations which I'm going to cover. Obviously, if the wording on the page is not clear, or the wording, let's say on clause A, is clear but contradicts or doesn't sit well with the wording 3 pages down, so that there is some internal inconsistency in the document, the judges will then intervene to find the interpretation that gives the best commercial efficacy to the contract. So the judges, in other words, will not be very activist in either England or New York, unless the contract itself is unclear or is internally inconsistent or contradictory, and then they would try to intervene to see what is the best commercial efficacy. One slide difference between the two systems. I don't think, having been on numerous restructurings, including some that have been litigated, one slight difference is that there is such thing as the covenant of good faith in New York law governed contracts. The covenant of good faith provides an overarching umbrella if the actual words in the contract are used by the parties in a way that is viewed as patently absurd or abusive, in a way that none of the parties had ever contemplated would be used, in such a way so that it gives the contract, it makes the contract devoid of its meaning. So it is some sort of, the words actually stick together nicely, but the actual outcome makes a mockery of the commercial soundness of the arrangement. New York law will say you can't go there. You cannot do a transaction that, albeit may comply technically with the wording of the contract, effectively upsets the very essence of that contract. But it is a concept that New York law judges apply very, very, very sparingly. They're not willing to do that sort of thing if you're really willing.
Thank you, Apostolos. We have just a few minutes left. So I have a couple of related questions. Just firstly around the kind of trends that you're seeing in Q1, so what we're seeing currently in the market. And I've got a question in about what are the most contested points in the market today. So kind of related questions.
Yeah, these are related questions. I think there's it's interesting. I think every time we sort of we launch a deal and we get pushback in the market through sort of flex of items in TLB or renegotiation or pushback in a high yield bond, it's always around sort of probably 6 or 7 related issues. I think there are, for example, RPs, synergies, and sort of cap on getting the pro forma benefit of synergies, whether it's going to be a cap or whether it is entirely uncapped, available amounts, and sort of the size of the freebie basket, and some of the abilities sort of to do second lien financings. I think affiliated transactions concepts, some of the if you like, named loopholes. I think the market, everybody, I think, is sort of using terms like Envision and Benchmark and Chewy and Neumann Marcus and CERTA and J. Crew and all of sort of these points. I think they're coming out of distressed restructurings, and these are all provisions in documents that provide certain flexibilities that perhaps the market thought were never intended when the documents were put together. So I think there's a sort of increased focus on switching off some of these protections. I think specified asset sales always, and what are the sort of right leverage thresholds for permitting dividends to be paid out of asset disposal. These are probably the areas that the market is focused on. Obviously, overall level of incremental debt capacity from day one capacity, like is it like 2 times, 3 times more than day one capacity, and what format overall dividend distribution level. And I think what are the hot topics haven't really changed very much in the last, I would say 18 to 24 months. The market continues to be very generous in covenants with the right deals, with the right credits, the credits that everybody wants to be in, and the market continues to be, I think, a bit more careful and more selective on the more difficult ones.
Thank you very much for that. I appreciate that. And it's a good stepping off point, because I can assure you we will make the full slide deck available. And you have dealt with some of those contentious kind of cases in the back, the envisioned certas that you mentioned. So that will be coming out to everybody who's been on the webinar today. Again, thank you very much for your time and all the information that you've shared today, Apostolos. And thank you very much to everybody who has joined the webinar today.
Yeah.
We appreciate it.
Absolutely. I think the slide should be made available. If people have any specific questions or observations or comments on, I'm always happy to give a one-on-one email correspondence. It would be very nice to hear from anybody who thought they want to raise something or make a comment or ask a question. Very, very happy.
Thank you very much, everybody. Have a good rest of the day.